As of 9:54 a.m. Eastern Time on this Wednesday, October 29th, 2025, the market is open, and Beyond Meat, ticker BYND, is actively trading at $2.01 per share. That's a gain of about 1.8% on the day, a modest move up. But that single quiet number hides one of the most chaotic and frankly dangerous stories playing out in the market right now. The expectation, if you just glanced at the news, is that Beyond Meat is having some kind of revival. You might have seen headlines about a 200% or 300% surge, an expanded deal with Walmart, or its inclusion in a new Meme Stock ETF. The expectation is that the short squeeze is on and this stock is on its way back. The reality, however, is that this recent volatility isn't a sign of a healthy business recovery. It's the financial equivalent of a Hail Mary pass. The company just executed a massive debt-for-equity swap, essentially handing over 80% of the company to its former bondholders to stave off a complete collapse. This isn't a comeback story, at least not yet. This is a story of survival, and the recent price action is a casino-like distraction from the fundamental crisis still unfolding. Let's be clear on what's been happening. Many investors, especially those new to online investing, look at a name like Beyond Meat and remember the hype. They remember when it was a market darling, a stock that felt like it could be the next Tesla stock of the food industry. It IPO'd and rocketed from $25 to nearly $240 a share back in 2019. The belief was that this company would completely upend the multi-trillion-dollar global meat industry. That was the narrative, and it was powerful. Fast forward to just last week, and Beyond Meat stock hit an all-time low of 52 cents. Not $52, 52 cents. From $240 to 52 cents. That is a 99.8% destruction of value. So when you see the stock suddenly rocket 600% off those lows in just a few days, as it did, it's not because the business suddenly found a magic formula. It's because the stock became a technical trading vehicle, a target for speculators. The recent surge was kicked off by two main factors. First, an announcement of an expanded distribution deal with Walmart. This is good news, getting more products into more stores, but the market's reaction was completely disconnected from the actual financial impact of that deal. The second and more significant driver was its inclusion in the Roundhill Meme Stock ETF. This effectively put a giant spotlight on BYND for every trader looking for the next big squeeze. And the setup was perfect for it. According to some data sources like Ortex, the short interest on Beyond Meat recently exceeded 100% of the free float. That is an astonishingly high number. It means more shares were sold short than were technically available to trade. This creates a tinderbox. When any good news hits, or when a wave of buying comes in from retail traders using platforms like Robinhood or SoFi Invest, the short sellers are forced to buy back shares to cover their positions, which pushes the price even higher, forcing more shorts to cover. This is the classic squeeze. We saw it play out in real time. But a short squeeze is not a business model. It's a technical dislocation in the market, and it rarely lasts. Now, let's pull back from the minute-by-minute charts on your Fidelity mobile app and look at the reality of the business these traders are gambling on. Just 5 days ago, on October 24th, Beyond Meat released its preliminary financial results for the third quarter. The numbers are bleak. The company expects revenue to be around $70 million. While that's within their previous guidance, it represents a 14% decline from the same period last year. This isn't a one-time dip. This continues the trend from their disastrous second quarter, where CEO Ethan Brown flat out said, "We are disappointed." In Q2, revenues fell almost 20% year over year. The demand that was supposed to grow exponentially is in fact shrinking, and shrinking fast. The company is blaming ongoing softness in the plant-based meat category, especially in U.S. retail. The core problem is that the category itself is struggling, and Beyond Meat, as the poster child, is struggling the most. But the revenue decline is only half the story. The real crisis is in the margins and the cash flow burn. For Q3, the company is guiding for a gross margin of just 10 to 11%. Even if you strip out the costs of them shutting down their operations in China, the adjusted margin is only 12 to 13%. You cannot run a sustainable manufacturing business with those margins. For comparison, a mature food company operates on margins 2 or 3 times that. This means that for every dollar of product they sell, they're making almost nothing, and that's before you pay for marketing, research, and corporate salaries. Unsurprisingly, the company is still losing a significant amount of cash. Q2 saw an adjusted EBITDA loss of over $22 million. They are burning through their reserves just to keep the lights on. This is the financial distress that led to the Hail Mary I mentioned earlier. Beyond Meat was sitting on a mountain of debt, over $1.1 billion, that was due in 2027. With revenues falling and cash burning, there was zero chance they could pay that back. Bankruptcy was a real, very near-term possibility. So the management did the only thing they could. They went to their bondholders and offered them a deal. Instead of us owing you $1.1 billion that we can't pay, how about we give you the company? They agreed to exchange that debt for over 316 million new shares of stock. This slashed their debt load down to about $250 million, which is a huge relief for the balance sheet, but it came at an astronomical cost to existing shareholders. This wasn't a small dilution. It increased the share count by roughly 80%. Anyone who owned the stock before this deal suddenly saw their piece of the pie shrink to a tiny fraction of what it was. This is why analyst firms like TD Cowen and Mizuho recently cut their price targets down to $0.80 and $1.50 respectively. They recognize that even if the company survives, the stock has been fundamentally revalued. The lockup period on those 316 million new shares just expired, meaning those former bondholders are now free to sell those shares at any time. This creates a massive, looming cloud of potential selling pressure that could absorb any buying from a short squeeze and send the price right back down. This is why comparing Beyond Meat to Nvidia stock or Apple stock is a category error. Those are cash-gushing, high-growth, market-defining businesses. Beyond Meat is, at this moment, a turnaround project that is fighting for its life. It's important for anyone doing self-investing to understand this distinction. You might use the same SoFi trading platform or Interactive Brokers platform to buy all of them, but the investment thesis is night and day. An investment in Apple is a bet on a dominant ecosystem. An investment in BYND right now is a bet that the company can completely re-engineer its business before it runs out of cash, all while fighting a meme stock battle that has nothing to do with its fundamentals. So what is the path forward? The company knows it's in trouble. They've hired the consulting firm Alex Partners to help with a massive transformation. They are cutting costs, trimming headcount, and just won an interim arbitration ruling against a former co-manufacturer, which helps. They are also trying to innovate, launching new, cleaner label Beyond Burgers and Beyond Beef at retailers like Erewhon, and expanding their six-pack at Walmart. The bull case, as thin as it is, rests on these efforts. It's a bet that they can stabilize the revenue decline, fix the broken margins, and convince a skeptical consumer to come back to the category, all while managing their new, heavily diluted share structure. The bear case is simply that it's too little too late. The competition isn't just from other plant-based brands. It's from cheaper, traditional animal protein. In an inflationary environment, consumers are downtrading to more affordable options, and premium-priced plant-based meat is one of the first things to get cut from the grocery list. Analysts are openly skeptical, with a consensus sell rating on the stock. Some reports even suggest that a Chapter 11 reorganization is still a potential outcome being explored. This is the kind of high-risk, high-volatility situation where having the right investment help is crucial, whether that's through Fidelity Wealth Management or just doing your own deep research. This isn't a stock for a set-it-and-forget-it intelligent portfolio, or one of Schwab intelligent portfolios. This is a speculative trading vehicle